Hey Sean, how are you?
Not bad. Yourself? How are things?
To see you. Nice to see you.
And you?
Very well, very well. What's new in the market these days?
Well, the Cyprus issue really threw things in the mix this weekend, but they're taking it pretty easy at the moment. But volatility is on the rise, and with FX volumes on the rise as well, it looks like it could be a pretty interesting time for the market, certainly in terms of future volatility.
It seemed to me as like the market went through like few cycles, like the uncertainty in the market sort of like shrank before the Italian election a bit, and with uncertainty after the election results, and now Cyprus seems basically there's like a spike again in uncertainty, like in where the market is going to go, which is going to make very difficult for corporations to enter into the financial markets to hedge the operational exposures.
Yeah, well, we've had a number of conflicting signals in the market, especially with stock markets going up. There's been a tendency to think that risk is pretty much safe now, and so up until sort of towards the end of last year, we were seeing volatility rates dropping to lows not seen since the Lehman times, pre-Lehman times.
Yeah, it's a very interesting point.
So the part of the reason that we've seen a pickup in volatility is that there's such great levels of entry in terms of people buying puts and calls in either direction, depending on currency, to hedge out. But certainly with the onset of the parliamentary elections in Italy and now the Cyprus issue, we're seeing extended levels, and it should really have set a base for volatility. These are still good levels for corporates to start hedging on the vanilla stuff.
So Sean, so far we've seen what corporations are inclined to do, like with the G10 exposure. Many corporations obviously have operations in Latin America, for example.
Yeah.
Is that a trade-off between hedging and not hedging with the Latin America exposure, given the stability of the currencies like BRL, for example?
Yeah. Well, the major issue with the emerging markets is that they're traditionally tied in with the general risk sentiment, which is sort of which is covered by the equity markets. The S&P 500 is a benchmark for risk indications, but more of the risk is seen in places like China, where we've seen such an explosion of growth and investment. India's already had its comeback, but when you look at Latin America, Brazil, the investment in infrastructure makes it a much safer bet. So I would assume that the risk hedging there would be not as aggressive as it perhaps would be in other areas. Perhaps there's more urgency in hedging out the risk to Europe rather than, say, Latin America. I don't think there's a greater expediency in trying to get the money out of Brazil, say, than there would be, I don't know, China or...
I understand. Just to wrap things up, Sean's trade idea for a UK corporation hedging risk in Brazil? In
Brazil. Well, certainly the near-term strikes, you'd be happy enough to cover and wear the risk. I think where the major blowout could happen in terms of the general equity picture, even though we said there's less of a chance of the money pouring out of Brazil given the infrastructure, there is still the general risk of a risk blowout.